We live in a world now where anybody, absolutely anybody can invest. You certainly don't need to be super smart or have a fancy education. Yep, even you, Susan. Just wanted to freak anybody out that was called Susan that happened to be watching. Now, I'm of the opinion that for at least 90% of us, you'd be much better off investing in funds to help spread your risk rather than trying to choose individual stocks and shares of companies to invest in. I say that through both my experience as a financial advisor and also that it's pretty well documented that blindfolded dart-throwing monkeys are better stock pickers than us. Between 1964 and 2010, a computer program, when faced with a list of 1,000 stocks to choose from, it was told to choose 30 at complete random in order to replicate the blindfolded dart-throwing monkey test. And you know what? 98 times out of 100, the monkeys won. What a world we live in. But I know for a lot of people, you still like the idea of researching and buying individual stocks and companies. And I do get it, I do it a bit too. And it's really easy, right? All you need to do is buy low and sell high. But how do you know when a stock is expensive or cheap? When it comes to analysing stocks, there are two camps that research normally falls into: qualitative research and quantitative research. Easy for me to say. Put your teeth in, Tom. And although they're distant cousins, people often bring them together before making a judgment on a company. It's a bit like dragging everyone round the Christmas table, even that uncle that you don't like. And to quote Investopedia, qualitative analysis uses subjective judgment to analyse a company's value or prospects based on non-quantifiable information, such as management expertise, industry cycles, strength of research and development, etc. Basically, things that are hard to put a number on. It's a bit like looking at Tesla and trying to work out whether Elon is a genius or a volatile lunatic. Yep, you and me both. Whereas quantitative analysis focuses on numbers, things you might find in a balance sheet, etc. And that's what we're going to be focusing on in today's video. So, you've got some money burning a hole in your pocket and you want to add an investment to your ever-growing investment portfolio. And let's say you've decided to add a manufacturing company. You've decided that you want something in your portfolio from a business that actually makes something. You know, like in the good old days. When anyone used to use an example of a business when I was doing my studying, they always used to use a business that makes widgets. So that's what we're going to do today. And despite being an amazing word that starts to sound really, really stupid the more you say it, widget, 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 widget. A widget is that thing that Guinness put in the cans of Guinness that makes it go shoo. In case you were interested. Moving on. So there are two companies to choose from. You've got Widgets R Us, and their shares are trading at £50 a share. And then on the other hand, we've got All About the Widget, and their shares are trading at £40 a share. Now, if that's all the information that you had, seeing as we all love a bargain and like to get the most bang for our buck, you'd probably go with All About the Widget, right? But the reality is, comparing apples with apples, not that apple, is very, very difficult. If you looked at these two businesses, you'd probably find that the profit that they're making, along with the number of shares that are in existence, are two very different figures for each company. So how do we begin to compare them against each other to see which one we might like to buy? You know, when you're in the supermarket and you're doing your food shopping, do you ever find it really, really difficult trying to work out which one is the one to buy when everything's a different size and shape and the offers are a bit different? Trying to work out which one is the best buy. Little tip for you, find the price per unit and buy the cheapest one, because that will see you paying the lowest price for your share of that particular product, no matter how big the bag is. And we can sort of do that with stocks and shares. Let's say that Widgets R Us are bringing in £100,000 in earnings and that there are 50,000 shares in existence. If we take that £100,000 earnings and divide it by the number of shares in existence, 50,000, we get something called the earnings per share, and in this example that is 2. And yes, I do use a calculator to check all my maths. Now, All About the Widget are actually bringing in twice that in earnings of 200,000, and there are only 40,000 shares in existence. So, in order to work out the earnings per share, we do exactly the same thing. £200,000 earnings divided by 40,000 shares, and we get 5. So although their stock price is lower, the earnings per share figure is actually higher because they're making more in earnings and there are less shares in existence. So what? Well, we can go on to use this earnings per share figure to work out the PE ratio. The price to earnings ratio, PE ratio, is the ratio for valuing a company that measures its current share price relative to its per share earnings. And it is worked out by taking the price per share and dividing it by the earnings per share. So, Widgets R Us, remember, has a share price of £50 and an earnings per share ratio of 2. 50 divided by 2 is the price to earnings ratio, which is 25 times. Whereas All About the Widget, remember, had a share price of £40 and an earnings per share of 5. So its PE ratio, price to earnings ratio, is 8 times. So what does this all mean? Well, it means that investors potentially paying £40 a share for a share of All About the Widget are paying a lot less for their share of company earnings than they would be at Widgets R Us, which could mean it's a better buy. But the problem is, using this information alone can suck you into a trap. A value trap. A value trap is when a stock or share seems to be cheaply priced because it's been trading at low valuation measures like a PE ratio. Basically, you're lured in because it's a bargain and the stock or share just continues to fall even further, and it turned out to be a dud after all. You bought the smart price biscuits and they were gross. Who knew? Well, you should know that when it comes to biscuits, there's only one champion, the chocolate hobnob. Cue everyone in the comments telling me your favourite biscuits. Come on. Now, one problem with PE ratios is they tend to look at historical figures, profit made from last year and the year before, etc. So they are backwards looking, whereas stock markets are forwards looking. And one way around this is to look at something called the forward PE ratio, which is looking at future predicted earnings. But the problem with this? Yep, you guessed it. It's a prediction, and predictions can be wrong. A bit like when I predicted after 6 months of YouTube I'd be on the next series of Strictly Come Dancing, and I'm still waiting on that call. One thing to do that is vital when looking at PE ratios is to assess it against two things: the long-term average ratio for that company historically, and the average PE ratio for the sector as a whole that that company is in. If you were to look at the PE ratio for All About the Widget, and historically it's usually a lot higher than 8, then it could be particularly cheap at the moment and could be an exciting opportunity. Their ratio of 8 certainly seems particularly cheap when compared to Widgets R Us ratio of 25, but we need to compare it to the sector as a whole. If we were to take a look at the widget making sector as a whole, however big that might be, if all those businesses in that sector tend to have PE ratios of around 20-25, then yes, All About the Widget could be a real bargain. But remember, is there a fundamental reason why this share is so cheap and standing out amongst the crowd? Is there a change in regulation imminent that's going to have to force them to change the way they make widgets forever? Or are they currently being sued because a small child has swallowed one? And this is where your qualitative research might come in. Is it a short-term blip that can be explained and therefore you still think it's an opportunity? Or is there a more fundamental long-term problem with the business and therefore it might not be such a good buy? And in the same way that a low PE ratio isn't always a good thing, a high PE ratio isn't necessarily always a bad thing. Perhaps the company just has huge growth and earnings potential. Maybe they've just struck a deal to be the sole supplier for widgets in the US. I really am running out of widget examples. I've really committed to the widget thing. One example is the PE ratios in the technology sector, because it's such a high growth industry, tend to be some pretty eye-watering figures, and you can't really compare those to some other sectors. Fortunately for you, you don't actually have to do a lot of maths to find a company's PE ratio. If you look here, if you go on Google and just type in, say, Facebook stock, you'll find this that comes up, and here is the PE ratio. And if you're now sat there thinking, right, so Tom, a low PE ratio could be a good thing, but you're also telling me that a high PE ratio could be a good thing. Well, thanks for the information, chump. Remember, what you're actually trying to do here is predict the future, and I think we'll all agree that that's impossible. All we're trying to do is use data and some research to try and make it a little bit less impossible. But impossible it remains. And if you've got nothing else from this video, at least you now know how to buy the cheapest biscuits next time you're in Asda. Widget, 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 widget.